Welcome to my video. Today we'll be discussing Petty Cash Fund. Petty Cash Fund is an amount of cash kept on hand to pay for minor expenses. There are many instances when the process of writing a check is inconvenient or a check is not accepted, therefore needing cash. For example, it can be used for office supplies, postage for small mailings, or other miscellaneous expenses. There are three main activities involved in its operation. First, establishing the fund. Second, making payments from the fund. And third, replenishing the fund. When a company decides they need a petty cash fund, it must be established with a journal entry. For example, for a $500 petty cash fund, we would debit petty cash and credit cash. Essentially, the company is writing a $500 check that would be cash to make the starter money for the petty cash box. The check is then given to an employee designated as custodian. That employee then takes the check to the bank and cashes the check in order to get the actual cash to put into the petty cash box. Now moving on to step 2, making payments from the fund. After the fund is established, the cash can be used for any qualifying expenditures. Payments are usually made in one of two ways. Cash can be taken directly from the fund to make payments, or employees can seek reimbursements from the fund for payments they have personally made. The custodian is responsible for tracking the money used and the receipts returned. It is important to note that as payments are made from petty cash, no journal entries are made. Journal entries are recorded only when the fund is replenished. As the cash in the fund decreases, the fund must be replenished. This leads us to our third step. At the end of the month, the custodian reconciles the petty cash fund by pulling the receipts and counting the remaining cash in the box. The total receipts received and cash remaining should equal to the original balance. The information is then given to the accountant to prepare the journal entry. In the journal entry for replenishment, a debit is made for each expense and cash is credited. The accountant will then write a check for the amount needed to replenish the fund back to its starting point. However, sometimes a business may find that they have a difference between their amount of receipts and their amount of cash needed to replenish the fund. In such cases, this difference is charged to an account called cash over and short. Cash over and short is a temporary account that can have either a debit or credit balance. A debit balance increases the expenses, whereas a credit balance decreases expenses. This difference can occur when the custodian doesn't collect all of the receipts or gives incorrect change. And that is all to Petty Cash Fund. Thank you for watching. Bye!